Hey YouTube, Casey Dim at TaxSaleAcademy.com and welcome to our weekly questions segment. This week's question comes to us from Lucas, actually a comment maybe. It says, I heard we could use tax assessments as a quick way to value property. Luca, thank you for your question. Now before I address that, I do want to remind everybody, you can grab this book right here, Tax Sale Playbook, for less than $5 by going to TaxSaleAcademy.com. All right, Luca. So using tax assessments as a quick way to value property. So a little of the backstory for those new to tax sale investing. So obviously, as an investor, we need to know the value of a piece of real estate. That means we need a way to figure it out. And oftentimes, we're going to be valuing a number of different properties as we go through the research process. More on this in just a second. But back to tax assessments. So the tax assessed value of a piece of real estate is the figure that is used by the county simply for taxation purposes. Basically, they send an employee out, he makes a few notes, then they go back to the office and they establish a taxable value. That value is then multiplied by a millage rate, and then you have your tax bill. That's the basics behind the real estate taxation system. So can we use that number, the tax assessment, as the value to help us determine how much the property is worth and subsequently to figure out how much to bid for that property? The short answer is no. Those tax assessments are often done very, very quickly. They're very cursory. And in some cases, such as vacant land, there really is never a drive-by performed. Instead, they group all the lots in a subdivision as the same exact value, even the lot that is the low spot of the subdivision that's underwater, for example. Those same assessments might also be based on an entirely different set of rules, such as a percentage of fair market value opposed to full market value. And that can really vary from one area to the next. The tax assessment might be 50% of full market value. And unless you understand that, it'll really throw you for a loop. We also must remember that the assessments might be one of 10,000 assessments performed by that county employee. So attention to detail is not all that great. And lastly, what if that assessment was used to value the property from last year when it had a house on it, but that house has since burned down? I've seen that happen many, many times. The proper way to establish a value is by performing your due diligence so you know exactly what the property consists of, then using verified comparable sales, which can easily be obtained from county records and many other places online, and then base your valuation off of those numbers that you know are accurate instead of the tax assessed value done by an appraiser, one of 10 or 15,000 that year, right? You need to do it where you know the numbers are accurate because that is your entire investment. So Luca, hopefully this answered your question. If you have a follow-up question or anyone else watching this video has a question, feel free to leave it down below this video or any of our other videos here on YouTube. And as always, check out TaxSaleAcademy.com to grab a free copy of your book or to join the Academy for our most advanced step-by-step training. We'll see you next time. Bye-bye.